get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Woodburn.
All right. Happy Monday.
Yes, sir. It is
November
Monday.
the 10th. We are getting closer. This year is wrapping up quickly, isn't it?
You know what's amazing is I said this earlier on. I think January of 2025 felt like an entire year in and of itself. And then from January 31st to today went by in about a minute.
Yeah. Isn't it the truth? Isn't it the truth?
Yeah.
Well, a couple things that I really want to cover. First of all, the government shutdown, I'm hoping, is coming to an end. It looks like things are getting a lot closer. I don't think anybody's been talking to each other for the last 35 days. I really don't. I think they just said, we're not going to agree with each other. Let's all go home.
There's been a lot of talking past each other.
Yes.
Right. A lot of talking
instead of negotiating. But maybe now, once these flights start getting all clogged up over the holidays, this is going to be a mess. So I think they finally realize we're going to have to do something and get this problem fixed. So let's just fix it and move on. The market has remained relatively flat. We've lost about 40 basis points on the market since the Fed cut. 40 basis points. So that's about $400 per every $100,000 that you'd borrow. So not horrible, but definitely did not improve with a rate cut.
Right. We've talked about that, right? We've already baked it in, and we've got another cut coming up sometime next month that'll probably do the same thing.
Yep. So quickly, I want to talk about an article I was reading about a lawsuit that Zillow is facing. So Zillow tends to be the go-to place for people to just search for home values and see what's on the market. It's kind of like a public MLS per se, although it's really not.
They have done a fantastic job of convincing the general public that Zillow is the market.
It's amazing what money can do. Yeah, money can persuade people to do anything they want. Correct. So then they decided to create their own mortgage company. Now, the mortgage companies are under strict rules with real estate companies that it's illegal to steer business. Correct. So in other words, even though Tom McNamara loves using Bruce Woodburn and his team for his clients, he cannot tell you that if you don't use Bruce, you're going to pay more for this house. That's or right. If you don't use Bruce, I won't represent you. You Correct. Can't do that. That's illegal. So what Zillow was getting caught doing is incentivizing or penalizing real estate agents for not referring enough business to Zillow Home Loans when they were giving them leads. So now the realtor signs up for Zillow. Now this is something consumers need to realize, because if you wonder why you may not be getting the level of service from a Zillow realtor, then this is why. First of all, if you are under the Flex program or their lead program, that real estate agent could pay Zillow up to 70% of the commission. 70.
I know.
Then they got to split the difference, the 30, 50-50 or so forth with their broker.
For sure.
Okay.
Plus we have expenses and all the other stuff that goes along.
And then, so what's left for the real estate agent in there? Now, that's why Zillow is getting these agents, and they don't seem to be as competent. But now they're facing lawsuits for steering people that are misleading and then penalizing that realtor if they're not sending them enough leads. That's highly illegal. You cannot do that.
So to be clear, right? So you and I are completely different businesses. We work together, we talk a lot, and we share leads, but there's no exchange.
There's no monetary exchange.
We don't exchange money. We just exchange friendships, right? Yep. And whereas Zillow is specifically having one arm of Zillow pay the other arm of Zillow, or drive the realtor to use both arms of Zillow at the same time and penalize that realtor for not doing so.
I think Rocket Mortgage is right behind him with that too, because now that they've bought Redfin and what they own Compass too,
there's a lot of consolidation happening.
A lot of consolidation. So when you start controlling that much, the consumer feels like, oh, this might be good for me. That's a one-stop shop.
Yep.
But Tom, let's talk about the reality of that. What happens when you do that?
Well, you eliminate choice. And when you eliminate choice, then prices go up. And we see that in literally every industry across, across the globe, right? Like airlines, how many airlines are there, right? There's only a few. Well, they're all the same, basically the same prices, blah, 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 right? So as you eliminate choice, you pay more money. Colleges, same thing, right? There's not enough room in the universities and to make it, competitive to get in there. So they charge more, right? And so we're starting to see that where consumers think that they're getting the best deal because they're bundled together, but they're really not, right? Because they're paying a lot of fees and they're not being given choices.
Not being
Of
given
competition.
choices. And when that real estate agent is told, if you do not send that lead over to this other department of ours, we're going to penalize you or kick you out of the club.
That's right. That's right.
And
I've
so,
never joined that club. It's not a club I want to be in.
well, that's because you don't want to be controlled by Big Brother, and that's basically that's happening.
That's
Now,
right.
I want to talk about something else that has been brought up, and that was that um, President Trump has announced that he would like to see us back doing 50-year mortgages for affordability.
Yeah.
So, if you stretch that mortgage out, then you can get your payment down. But I don't know if it's going to be as attractive. So let's just look at some numbers here.
Sure. Sure.
Are you able to share that?
It's shared. It's shared. You should be able to pull it up.
Let's see here. I got it right here. Here
There
we
you
go. Okay, so here's a chart. And forgive all of our logos and everything for blocking some of it. But as you can see, on a $300,000 mortgage, you're only saving $102. And here's why. The interest rate on that 50-year mortgage is not going to be the same as a 30-year mortgage, just like a 15-year mortgage is a much lower interest rate than a 30-year mortgage.
That's right.
So the longer you expand it out, the higher that interest rate is going to be. So, Tom, share with our listeners why that is.
Well, obviously, there's risk in the bank lending money for a period of time. And the longer that period of time, the more risk. And then there's another factor that a lot of us don't ever think about, and that is what a dollar is actually worth in the future, right? So a dollar 20 years, 30 years, 50 years from now is significantly less impactful as purchasing power than a dollar is today. And I give an example. One of my early mortgages was from the mid 90s. And, had I just kept paying that payment, it was maybe $1,000 a month, right? For that property. At the time, it was a significant payment. Today, it's virtually nothing. People pay $5,000.
Well, here's the reality of it too. You nailed it. That time frame, that dollar erodes over a period of time because of inflation. So
right.
Think about this. What could you buy in 1975, 50 years ago, for $100,000? Now, in 1975, my dad was a builder, and he was building homes, and those homes were selling for about 55 to 60,000. That same home today is $650,000.
Exactly right.
That's
exactly.
how money works. So why would the bank loan you money consistently over that time period and not be able to build in some type of hedge? I don't know. I just don't see it being worthwhile, not only for the bank. I don't even think it's worthwhile for the consumer.
I agree. I think it's when I first saw it, I was like, okay, maybe that's a stepping stone to get into a property. That was my first initial thought, right? Obviously, I would never advocate for somebody to get into a 50-year mortgage and pay it for 600 payments. No. That's silly, right? I don't even recommend somebody get into a 30-year mortgage and pay 360. Figure out a way to pay it off faster, right? I mean, don't just keep making the payments. But as I look at it now, I'm like, it's $100. It's $135. That's virtually
nothing. On $400,000 purchase, you're saving $135.
Right. And so if you figure that the ballpark, $60 per 100,000, right? That gives you $20,000 worth of extra value. Like, I mean, that's not increasing your purchasing power enough in trade for what you're going to be spending.
I agree. And I think if you did use it as a tool to say, okay, this $135, it is the make or break point where I can buy or can't buy. If that's the case, if that is the case, and I think it'll be rare, but if that is the case, then do the 50-year mortgage if they even come out. Right now, they don't meet QM guidelines. They meet Dodd-Frank, but they don't meet QM because
Right.
when they developed the new QM guidelines, they eliminated anything longer than a 30-year mortgage, and they eliminated interest-only conventional loans. Those
Correct.
were good things. Those were good rules that we enacted. So
Yeah, eliminating them were good things.
yeah,
Yeah. Yeah. Those were
eliminated.
the reason, those were the real reason we had that market crash back in '07, right? I mean, that was the start of the whole thing.
Well, I mean, more so, it was really doing bad mortgages, allowing people to buy that didn't really qualify. But you could mix in the neg am arms in that as well. But primarily, it was 100% financing for people that could fog a mirror. And that was the problem. That
Sure.
doesn't exist anymore. But
Right.
if you do the math on a 50-year mortgage versus a 30-year mortgage, I'd stick with the 30-year mortgage. I don't think a 50-year mortgage is going to be the best thing that ever happened.
I agree. I agree. I've spent a little time this weekend looking at it. And again, I analyzed it positively first. I was like, man, great stepping stone.
Me
Get you
too.
property. And as I'm digging into the numbers, I'm like, it does not make sense. Maybe it makes sense for 2 to 5% of the people that are like right there on the edge. It helps them get in 2 or 3 years, 5 years down the road. They refinance into a smarter mortgage or, whatever. But nobody should ever get into a 50-year mortgage and pay 600 payments.
No.
Don't ever.
No, don't do it. As a matter of fact, even on a 30-year mortgage, when it's time to refinance, if you can entertain a 20-year mortgage or even a 15-year mortgage, instead of trying to drop the payment that you're used to making, why don't you drop the term of the loan and save the interest on it?
Sure,
Doesn't
sure.
that make a
Well,
little bit more sense?
absolutely. And the other thing that, and we've talked about this before, is just making extra principal payments, right? I mean, the nice thing about having the 30-year, if it's, I don't want to say if it's a stretch, but if it's your budget and you got the 30-year and you're good, when you make some extra money, you can pump money down onto that,
And it
right?
goes right to
And
principal.
but you're not obligated to. Whereas if you get a 15-year, you are, right? So you
I
can
agree.
start paying that extra. And and let's face it, once we start doing automatic payments, if I'm paying an extra $50 or an extra $100 over time, that stops being impactful for me because it's automatic. If I don't put it on automatic, it's a little tougher because I got to think about spending extra money, right?
It's the same with savings. I highly recommend people max your 401k out, whether your company is matching you or not, have it taken out of your paycheck after you've done it 3 or 4 times. That's just what your paycheck is. And now
Yep,
you're forced yourself to saving money. You can do the
absolutely.
same thing with a mortgage. And that's how you build wealth. You
Yep,
don't build wealth by charging the George Foreman grill and an 80-inch screen TV on your credit card and paying it over 72 months.
no,
That's not, there's no wealth building in that.
not at all, not at all. No.
So those are the big deals. You got Zillow. Watch out for Zillow. Listen, I believe Zillow, it may have a purpose for maybe people searching the internet, but to be honest with you, call Tom. He can do a better job of it and give you more accurate information. When
Absolutely.
somebody tells you that you should use this mortgage company or you have to use that mortgage company in order to get these incentives, that is in essence extortion, and you should be highly, highly aware of that. So don't get tricked into fast talking salespeople that are trying to get you to do something when they say it saves you money by doing that, and
That's
they
right.
paid for the lead to get it. So don't do that.
100%.
And then 50-year mortgages, I'm kind of out on it. I'm not completely sold on it. It might work for a few people, but in my opinion, let's stick with the meat and potatoes and get the job done, get you into a house, and then you can start lowering your payments as interest rates drop or even consolidate to a
I think
15-year.
ultimately there's got to be a lot better tools we can use to make homes more affordable. The biggest one is to meet demand or exceed demand. If we start doing that, home prices are going to level off and or come down.
Yep.
And
Well, right
all that,
now, you're going to have, with a shortage of inventory, then you're going to have trouble getting interest rates down. But right now, I don't see a real shortage of inventory in our market. Do you?
no, we're pretty level. I mean, there's a shortage of good inventory. There really is. I mean, I have some buyers I'm walking around with, and we look at a bunch of houses, and they're like, "Oh, I love this one. It's great." And we look back, and it's gone. And the other four that were either for price reasons or other reasons weren't hitting it for them, those are the ones that are going to sit. If you have the great house at a reasonable price, it's going to sell quickly in this market. If you try to extend and get more than the house is worth, it's going to sit. That's all there is to it.
Roger that. I got to run, my friend. It's a great Monday. The weather's getting cool in Florida. What a great time to go out and buy a house. If you're thinking about refinancing, I'm going to tell you one more thing. We've all expected that rates were probably going to drop sometime around the first quarter of next year. Now I'm starting to see indicators that might not happen.
Oh, no. We'll have
That
to talk
might
about
not
that
happen.
next week.
So we'll have to address that. I'm watching it very carefully, but a lot of the economists are saying we're going to have a reversal on that, and we're not going to see the rates that we thought. I saw some predictions that even mid-year next year, they're going to be still around 6.4, which is higher than they are today. So is that, and that might really cut out a bunch of these people refinancing. And if you were thinking about refinancing and the lender said to you, I can save you $250, and you said that's not enough, and you don't do it, and interest rates go up instead of down, that $250 could have saved you $100,000 in interest.
There you go. There you go.
So pigs get fat and hogs get slaughtered. I got to go.
All right.
See ya.